Welcome to the Corporate Treasury 101 podcast. I'm Hussam.
And I'm Guillaume. In this podcast, we are going through the fundamental concepts of corporate treasury, which I learned from my experience working at a Big Four consulting company.
And he'll explain it in a way that someone like me who knows nothing about the topic can understand.
We hope you enjoy the episode.
So, Guillaume, in the last episode, we talked about interest rate risks.
Yes.
Right? We said, okay, you could have fixed interest rates, you could have variable interest rates. Now, we already talked through the FX, right? The foreign exchange risks, and
Yes.
you took us through how you mitigate those with your hedging.
Yeah.
How do you do that for interest rates, though?
Yes. I know you like examples, Hussam. I
Love them.
kind of like them as well. So let's have one here. And let's have one that we can all relate. So, Hussam, if you were to start your own business, what would it be?
I would open my own cafe with the best penne chocolats in the country.
Love it, man. Sounds lovely.
You?
Okay. Well, I'd be in the same industry, but more of a restaurant, I think. Yeah,
So we don't compete with each other.
Exactly. So you can sell your pain au chocolat, and I sell the best crepes Belgian people have ever tasted. What do you think about that?
Sounds like a good idea. We can be next to each other.
Let's do this. City center of Brussels, does that work for you?
Perfect.
Okay, let's do this. So, lovely business plan. We're going to make a lot of money out of it, but more importantly, we're going to live our passion, right? So, in order to start our business, Hussam, we both need 100,000 euro loan for some reasons, like buy the stuff, start the business, hire some people, getting your working capital management working, etc. So, we both need 100,000 euro. We're going to contract a loan. You have your cafe, and the bank grants you a fixed rate loan of, let's say, 5% per period. A period can be 1 month, 3 months, 6 months, 1 year, whatever. 5% interest fixed per period. Well, for my restaurants, the bank is a little bit skeptical. They do not want to take too much risk. And they say, okay, we're going to finance you. We're going to lend you 100,000 euros, but you're going to have a floating rate loan. What does it mean? The bank is going to tell me, okay, Guillaume, we lend you money at the condition of LIBOR plus 2% per period. What in the living hell is that again? So
you say LIBOR?
LIBOR.
LIBOR.
Exactly.
What does that stand for?
So LIBOR stands for London Interbank Offered Rates. So it's a rate at which banks lend money to each other. This is basically how much it costs the bank to lend money. Like, okay, I'm getting the money at this LIBOR rate, and then I will need to apply my margin on it, right? So we call this a benchmark interest rate. Again, that will be for another episode. But we wanted to introduce the term of LIBOR here.
Okay, so I pay 5% of the 100,000 that I borrowed in every period, whether that's annually or monthly or whatever.
Exactly.
So 5,000 euros.
Exactly.
Right? But you pay for your restaurant LIBOR plus 2%.
Yes.
Which means...
Okay, so let's take period 1, right? Period 1, you're gonna pay 5%. Fixed, you pay 5,000 euros. I pay LIBOR plus 2%. Let's say for this first period, LIBOR is equal to 2%. That's the costs of money for the bank. So they say, okay, Guillaume, this period LIBOR was 2%. I'm adding my agreed 2% margin on it, which makes an interest rate of 4%. I need to pay for the loan of my restaurant 4,000 euros.
So you win. You get to pay less than me. So I should have a variable rate as well.
So in that case, indeed, I appear to have a better deal than you. But in period 2, LIBOR has fluctuated a bit. The world economic situation has a little bit more uncertainty. Banks tend to be a bit more careful. So let's say LIBOR is 5%, to which, again, my bank is adding this 2% margin. So now I end up paying 7% of interest on my loan, which makes it 7,000 euros for that period. And so on. It can vary every time.
Okay, so I'm always sure So I'm taking the low risk approach, which is I know it's 5% every period. Let's say that's every month or whatever.
Yes.
I'm paying 5,000 every month, whereas you need to wait for the letter to come through the door to find out how much you need to pay.
Exactly.
And you carry that risk.
Exactly.
But you could win or you could lose. And these LIBOR, these are like published.
Yes, it's public information.
Everyone's aware of it, and you can and do you know what affects those? What creates one to go up or down?
So this is a bit too technical for me at the moment, but we'll keep it for another episode, Sam, with great pleasure. Yeah, thanks for challenging me.
So what if LIBOR goes off the rails? Like if it's like 10%,
Yes.
right? Then you're paying 12%, which is 12,000.
Yes.
Right?
And I might as well go out of business.
Yeah, exactly. Or it goes to like 0.5%, right?
Yeah.
And then you're paying almost nothing.
Yeah.
Especially compared to the fixed rate like this. Could go anywhere.
Exactly. So again, it depends on my risk appetite, right? I'm a small restaurant. What I tend to do is to be conservative, not take too much risk. But I didn't have a choice. The bank granted me a loan of a floating rate, LIBOR plus 2%. Now, Hussam, I feel that you like risk, and I hate it. I hate risk. I want to be able to plan my budgets, to have consistent, predictable growth. I want it to be steady. So I'd rather go for a fixed loan, but that's not what I have. Now, you love risk, and yeah, in your mind, you think eventually the LIBOR will go down. So you'd earn money having not a fixed rate anymore, but a floating one that will eventually make you pay less than 5,000 euros per period. So knowing that, plus you're a very good friend, we have our business next to each other, so we talk every morning around those awesome pain au chocolat of yours. So I come and I propose you a deal. Look, Sam, I'm gonna pay you 5,000 euros per period, no matter what happens. Those 5,000 euros are yours, and you can use them to repay your loan. But in exchange, I would like you to pay me LIBOR plus 2%, no matter what. Either LIBOR goes up, goes down. It's not my concern anymore. You like risk, you take it, and you might. I think it's a good deal for you because I also think LIBOR will go down, but I cannot take the risk. So what we are doing here, we are exchanging our interest rates payment condition. We do a swap. And a swap is the name of the instrument that is used for such situation.
So, although we both have our individual contracts with our banks, we can, between us, swap our contracts because we're in different, maybe people are buying lots of pain au chocolats right now.
Exactly.
And I'm willing to take the risks more now, right? Because I've listened to a great podcast about public treasury, and I think I know a thing or two about what LIBOR is going to do.
Excellent.
So I decide, you know what? I'm not going to go back to my bank and adjust my contract because it's fixed over a period of time and that's too much effort or whatever. But you're proposing me a swap. I think LIBOR is going to go down. I think it's a good deal for me.
Okay.
And then we would swap our contracts between us, create a new one, independent from the one that we have from the banks.
Exactly.
Based on our current needs as independent businesses.
Yeah. So exactly. So that's quite a basic example of how a swap works, but that's exactly it. Now, in the real life, you would have those swaps with the bank, again, with a financial institution, able to deal this kind of derivative again. But indeed, that's the mechanism. That's exactly how it works.
So this reminds me of the thing that I think in all my economics classes growing up I studied was always the 2007 crash, right?
Yes.
And we're kind of giving away our age that we studied the 2007 crash.
Ouch.
As opposed to lived it.
Exactly.
But that's I heard something like this, right? Interest rates went up.
Exactly.
Right?
So, yeah.
So everyone with a floating interest rate had to pay a lot more. So all the borrowers all of a sudden had to pay a lot of money.
Exactly. So many things happened during that crisis. The interest rate, the floating interest rate were a thing, not the only one that led to this crisis, but indeed, that's what triggered it in the first place. So the Fed, the Federal Bank of the United States, at some point decided to change its economics policy, and they say, okay, we're gonna raise up the interest rates. It ended up having increasing interest rates for all the borrowers of mortgage who were able to buy houses like this, and therefore they were able to afford their loan anymore, which had what we call a systemic effect because of also toxic products, but that's for definitely another episode. But indeed, floating rates were involved in those crises, in those events during the crisis of 2008. Yeah, absolutely.
That's super interesting and relevant. It's good to know.